Welcome to our explainer on the modern gold market. If you've been watching the financial markets lately, you already know gold has been, well, absolutely explosive. It's dominating the headlines, shattering historical records left and right, and totally changing how both everyday people and massive global institutions think about wealth. Today, we're going to decode exactly what is happening in this unprecedented era. We'll separate the hard data from all that media noise and break down the smartest ways to actually navigate these massive market shifts.
Okay, so let's quickly run through our roadmap for today. We're covering the global gold price surge, China's real strategy, the physical gold problem, the sovereign bond solution, and we'll wrap things up with some smart trading tactics. Section 1, the global gold price surge. Let's start with the big picture that literally everyone, from central bankers to your neighborhood day trader, is talking about.
I mean, just look at the sheer scale of the move we are witnessing here. Over a 5-year period, gold has seen a staggering return of over 129%. By July of 2026, spot gold blasted past $4,175 an ounce. This isn't just your standard, boring inflation hedge anymore. It is a massive wealth generation cycle. But, with massive growth comes massive volatility, and naturally some very confusing headlines.
Which brings us to Section 2, China's real strategy. Let's look at how this global surge turned into a major geopolitical catalyst that probably sent a few alarming alerts to your phone recently. You have definitely seen the clickbait, right? Things like, China stops gold trading or meltdown in the East. Well, we have to address these rumors head-on to set the record straight on what is actually happening in the world's largest gold consumer market.
So here is the crucial point. China absolutely did not ban gold, not even close. What actually happened is that major institutions like the Industrial and Commercial Bank of China, which is literally the largest bank in the world by assets, announced that effective July 2026, they would pause intermediary services for individual retail investors who are trading leveraged paper gold on the Shanghai Gold Exchange. The physical market, completely open. Institutional buying, still happening in full force. If we trace the timeline of China's market, we can see this isn't some wild market panic. It's actually a very mature regulatory move. When gold hit those record highs, everyday retail traders in China were experiencing extreme FOMO, fear of missing out. They were taking on 10x or even 20x leverage. Now, gold corrections of up to 30% are entirely normal after huge run-ups. So to prevent a complete retail wipeout, kind of similar to a tragic crude oil leverage scandal that wiped out everyday investors back in late 2020, the government stepped in to freeze retail leverage. They're just protecting their citizens from paper risks, definitely not turning away from gold. In fact, the hard data tells a totally different story about China's massive physical accumulation. In just the first quarter of 2026, consumer demand sat at over 303 tons. Between January and May, they imported a whopping 692 tons. But here's the real kicker. The People's Bank of China has been on an aggressive 19-month buying streak, bringing their official reserves to over 2,331 tons. They are hoarding the physical asset while discouraging everyday citizens from gambling on the paper asset.
All right, let's jump to Section 3, the physical gold problem. We're pivoting from China to see how everyday investors in places like South Asia face some really severe risks with the physical metal itself.
In markets like India and Nepal, gold is deeply woven into the culture. It's a beautiful ornament for happy times and a crucial financial safety net for hard times. But when you compare the options, it reveals the harsh financial realities of buying physical jewelry as an investment. The second you buy it, you're hit with 12 to 18% in making charges. Then you face constant theft risk, which means you're paying for bank lockers. And crucially, a gold bar just sitting in a safe yields absolutely zero interest.
The reality is, if you buy physical jewelry, the spot price of gold has to surge tremendously just for you to cover your initial making charges and storage costs, let alone actually turn a profit. It's a culturally beautiful tradition, sure, but mathematically, it is highly inefficient as a pure investment strategy.
That leads us perfectly into Section 4, the sovereign bond solution. This brings us to a really brilliant financial tool, aiming to solve this exact physical gold dilemma for the everyday investor.
By definition, the sovereign gold bond, or SGB, is a total game changer. Issued by a central bank, it acts as a direct alternative to physical gold. You can buy it in digital or certificate form starting from just 1 single gram. It links directly to the market price of gold, which completely eliminates those pesky making charges, the storage costs, and all the stress of potential theft.
But the ultimate advantage of the SGB structure is its dual benefit.
Not only do you get the full capital appreciation if the global price of gold surges, but you also get a fixed annual interest rate, historically around 2.5%, paid directly to you just for holding the bond. It literally turns a non-yielding yellow metal into a cash-flowing asset. How cool is that?
But, as always, there's a catch, and we definitely need to look at the government's perspective here. While SGBs are incredibly safe and lucrative for citizens, soaring gold prices make them very expensive liabilities for the issuing governments. See, governments win by reducing the massive foreign exchange outflow used to import physical gold. However, when global gold prices absolutely explode upward, the government's obligation to pay back that heavily appreciated principal, plus the interest, becomes a massive, massive budgetary burden.
And finally, Section 5, Smart Trading Tactics. Let's drill down to the micro level for viewers who understand the risks and still want to actively trade these huge market swings. If you're trading the paper or spot market, following these logical steps is absolutely vital. Professional traders will tell you, emphasize patience. Do not buy into the frantic breakouts when the market is feeling totally euphoric. Instead, wait for pullbacks to clear support zones. Use small lot sizes, because if you over-leverage, you won't have the trading psychology to hold through the natural ups and downs. And always ensure your potential reward is at least 1.5 to 2 times your risk.
I really love this concept. Always remember that taking a calculated small loss is just a completely normal requirement for catching a massive, profitable swing trade. Actually, if you take a strict planned loss on a pullback that dips just a bit too far, that is a good loss. It preserves your capital so you can re-enter safely and catch those massive macro trends we talked about earlier. For those of you actively watching the charts right now, these are the actionable technical levels you need to know. There is heavy resistance up in the 4,400 to 4,450 zone. That's a place where major institutional order blocks are sitting. Conversely, the 4,000 psychological level is acting as massive support, and it's being heavily defended by buyers. Keep your focus strictly on these key levels and basic price action rules, rather than getting distracted by all the daily media noise. As money evolves, central banks hoard bars, and digital bonds replace jewelry, we are literally living through a massive structural shift in wealth. So I'll leave you with this final thought to consider. How will you adapt your portfolio to the new era of digital gold? Thanks so much for joining me for this explainer, and keep learning.